like to talk about a topic that I, in the past, didn't used to talk about. I used to talk about central banking. Today I'd like to talk about decentral banking. Now, we're all presently concerned with some of the things that are happening in the economy. Inflation. Is it going to get worse? Are we where we were a century ago in Germany when modest inflation started to rev up and the numbers became bigger and bigger? Well, obviously you should talk to those who forecast the present inflation, not those who were surprised by it. And I warned in April, May, and throughout 2020 there will be significant inflation coming up 12 to 18 months later, and this is what we are currently, of course, experiencing. How was that forecast possible? I will show you. I will give you the tools that you need. And I think it's important to also go back to an earlier experience, half a century ago, when we had significant inflation and when we were told an official story about why there was inflation in the 1970s, and we have to critically examine that. It was a decade of stagnation and inflation, stagflation. The US consumer price inflation peaked at 13.5% at the end of the decade. Of course, as you know, the first bout was in 1974 with 11%. Germany did a bit better, but these are all the peak inflation rates in that decade. Other countries, Japan, the UK, had fairly high double-digit inflation, 23, 24%. Why this inflation? What is going on with the monetary system? The official narrative, I'm sure many of you will know, is, well, these are external events, nothing to do with the central planners. A war broke out, OPEC therefore imposed sanctions against the US and Europe, creating an energy supply shock, causing an oil price shock. Now, all this happened in October 1973. So then we see the oil price jumping from $3 per barrel and that was in September 73 to $12 per barrel in the following January 74. That's the story. And of course, today the story is very similar. War, sanctions, energy supply shock, energy price shock. Let's look at the evidence. But to answer that question, we need some tools of analysis. And while we're at it, and while I'll show you these tools, we might as well solve some of the other big puzzles in the official narrative that they haven't really explained to us. Why do we get these as-surprise bubbles followed by banking crises? There's been 100 in the past half century. Why haven't the regulators learned how to avoid these? Why have those developing countries that adopt the recommended policies by the IMF and the World Bank, why haven't they been successful? I mean, how many, since the World Bank and the IMF were created at the end of the Second World War, how many have moved from developing country status to developed country status? Oh, none? Well, 5 countries did, but they didn't follow the IMF, World Bank, Washington Consensus advice. Well, how did they do it? China, Japan, Taiwan, Korea, Singapore, how did they do it? What policies did they adopt? And of course, the question we started out with, why the present inflation? And why didn't the QE, central bank stimulus in 2008, not cause any inflation? Of course, that's what took a lot of people by surprise this time round in 2020. It's going to be like 2008, no inflation. Of course, the same people in 2008 said inflation is going to happen. So they got it wrong time and again because they used the wrong tools. What are the right tools to analyze this? And as we explain this, we can also explain why Japan, so successful for many decades, on track to overtake the US by 1993 in GDP, actually then did not overtake just before, in 1992, moved into a 20-year recession. What happened there? There's another question we can solve with the same tools. In the UK, they are constantly concerned about low productivity. Why is productivity so low in the UK compared to Germany? Much higher productivity there. What's happening? All right, so you need those tools. These are the secrets of the banking trade and the rules of the money game. If you ask ordinary people out there what matters in the economy, I bet you they'll say money, banks. And of course, that makes some sense. If you ask the expert economists, they will talk about anything else but money and banks. They don't matter, they're left out of models, and they will say, well, the interest rate is what matters. Consider interest rates. But when it comes to banking, some of you who haven't studied this as a topic may be surprised that for a whole century there have been three theories of banking, and the experts couldn't agree which one it was that was actually explaining what banks were doing. Since the 1960s, the dominant theory is the financial intermediation theory. Banks are just financial intermediaries. They're just like non-banks. There's nothing special about them. The older one from the 1930s to 60s is the fractional reserve theory, which says that each bank is a financial intermediary, is not special, but somehow in the system there's something going on, like money multiplication. And then there is a third theory, the credit creation theory. That's the oldest. And that says, no, banks are not financial intermediaries. Each bank individually creates new money.